Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. Hello and welcome everyone. Today I'm joined by Michael Lebbon, who is the founder of Emmi. Michael, welcome.
Hi Alex, thanks for having me.
So let's kick off with your background. You're now looking at carbon risk within investment portfolios, but I'm really curious to get a background into you and what actually took you on this trajectory to starting to price carbon.
Yeah, so Alex, I've sort of been in the carbon markets and pricing carbon, trading carbon and climate finance for over 15, going on more than 15 years now. So I have a finance background, CFA charter holder, did all the things you're supposed to do as a sort of 18, 19, 20-year-old that wants to get into the financial industry and investment world. But I then, when I was just finishing uni, my undergrads, I had an opportunity to go and work for one of the large investment banks. And I got taken aside by a few people and actually asked me, why, do you want to do that? And I didn't really know, to be honest, what it meant to be an investment banker, let alone a graduate investment banker. So I had a few people give me some wise advice, like, what do you want to be doing? And I said, well, realistically, I'm actually really interested in asset mispricing and behavioral finance. One thing led to the other. And what someone actually said, well, if you're interested in mispricing, why don't you go and have a look at carbon credits? At the time, like this is 15 plus years ago, I didn't know what a carbon credit was, but I had a look at it and I saw that one carbon credit was worth 50 cents, yet another carbon credit was worth $50. But they were both denominated in a ton of CO2 and effectively were supposed to be doing the same thing. So you don't really need to be a finance genius to go, home. There's a bit of an arbitrage there, isn't there? Buy the 50 cent one, sell the $50 one, mispricing, probably some behavioral finance effects going in there. So I was captivated. That's what hooked me, was just like, well, there's a bit of arbitrage to be had. I then uncovered why, understood all the different carbon credits, why they were, additionality, fungibility, global carbon pricing. And it just drew me in. The fact that climate change could be solved by the financial market if we can internalize the externality of carbon emissions just captivated me. And I couldn't stop reading about it. I was reading it, I decided, made a decision. I don't want to do investment banking. I actually turned down the job offer and went back to university to do an honours year in finance on carbon emissions. Took a little bit of negotiating with the university to find someone that could supervise me. And then just jumped in it. It was something that's always captivated me, and intellectually it captivates me about how we can get system change in getting the financial markets to price carbon in one way, shape or form. But it also really aligns with, the way I live my life. Like when I'm not working, I like to be outdoors. I run, I surf, I ski. I want to also leave the world in a better place. So I like getting up in the morning going, well, I'm actually going to work to use my skill set in finance, in the financial markets, to try and, leave the world a better place.
A lot's changed in the last sort of 15 years around carbon pricing. I'm really curious to get a feel for what did you see when you were doing your honours and learning about carbon emissions and carbon credits, for example, as we look to today.
Yeah, so it's really interesting. Again, as a young 20, 21-year-old, one of the things that captivated me and that I was, had big thoughts about, dreamt and sort of daydreamed about was global carbon pricing. We're going to have one big globally applicable carbon market, and the fact that you could basically create carbon credits in Australia that would be fungible in Europe, would be fungible in the US. The Kyoto Protocol was going to come on board, and basically governments were going to solve this. And we're going to have this big, dare I say it, collaborative, happy family, global carbon market that governments were leading. And that was the big push. That's been the big push for, the last 30 years realistically. But 15 years ago, it was very much that. Unfortunately, in 2007, 2008, we had the GFC. And back then, carbon and climate was seen, doing something around carbon and climate was very much seen as a cost. There was no opportunity thought about. It was only a cost. We have to carbon constrain. We have to price carbon emissions. It's an extra cost. Before the GFC, we thought we had people had spare cash. Sure, we'll do something about the environment. Then the GFC hit, and carbon and climate took a very big backseat for a few years as everyone sorted out their financial systems. or their financial basically survival. But from there, what sort of changed, and it's been a slow build, but it's gotten bigger and bigger, was after the GFC, the Financial Stability Board was set up to basically go, okay, where is the next systemic shock or shock that global shock potentially going to come from for the financial system that we need to be aware of? And they basically worked out that climate change and the decarbonisation requirements was one of the biggest ones that they needed to be understood in markets. So from that point, markets, the financial system started to work out that perhaps government isn't the solution to climate and carbon markets, and that maybe they need to start doing things themselves and taking that on their shoulders. And they've got massive capital power. If they can leverage it in the correct way, they can actually produce the outcomes. But can we do it in a way that doesn't require or doesn't wait for government? So that's now where I've seen the shift is government is still required. They still can very much drive policy and action, but the financial markets are now starting to look at how do we do this in our own private sector approach, not necessarily from a global explicit carbon price, but you've got sustainability linked loans, you've got green bonds, you've got climate financing, you've got people now imputing internal carbon costs, all starting to basically build these systems out themselves. So the private market can really start to understand this and effectively get ahead of the curve.
Let's take it to the place of the market, right? If we think about capitalism working and the allocation of capital, you're now introducing a new cost for these companies, ultimately, that they need to deal with. Companies are great at obfuscating their duties in many cases and trying to reduce costs. How do you think about trying to encourage companies to do something about carbon risk at the same time when the government maybe is not so clear as well? How do you balance those two out?
I guess the way I like to look at it, and I think some of the markets now coming to this point, is carbon is rather than carbon being, I think then this is just going back, sort of finishing off the last question as well, is carbon, rather than seeing it as a pure cost, is potentially more a risk or an opportunity. So if we think of it through that lens, you can sort of start looking at it in the same way that we sort of look at debt and credit ratings, as in right now, this is not a go to zero tomorrow issue or requirement. This is a net zero over the next 20, 30, 40, 50 years. So it's effectively how productive are you being with your carbon emissions? And so the way that the market can sort of help companies to understand this is in the same way that we look at credit ratings, is you don't necessarily have to go to zero tomorrow, but in credit ratings, you can have a sizable chunk of debt, but so long as you're being productive enough with that debt so that you can effectively, you've got the financial resilience and the productivity and the value to be able to service that debt. That's how we see it, or I see it, and a few other people are starting to see it with carbon, is it's not about going to zero tomorrow. It's the carbon emissions that you've got, that's okay. It's not necessarily a cost, but how are you servicing those carbon emissions? Or in another way to put it, are you being productive enough from an economic value perspective for the carbon emissions you have, so that as these carbon budgets get tighter and tighter, you can continue to basically operate and you effectively still produce the products and services you are doing without effectively having increasing costs come your way. So the only difference that I will say between a credit rating and a carbon sort of analogous rating is the carbon budgets get tighter and tighter. So you have to always be looking about what are you doing next. With credit ratings, your debt can be a little bit more constant.
It's interesting. It looks to me as some sort of an efficient use of carbon. Like with a portfolio, Absolutely. You're looking at maximizing return for a given level of risk. You're looking at maximizing growth and opportunity for a given level of carbon.
Absolutely. And that's how I view it. And, again, people that we're talking to are starting to view it is you treat carbon as a risk. It just turns into finance 101 again. It's any given level of risk, you need a given level of return. So if you have more carbon, i.e. you have more risk, investors should start demanding a higher level of return from you. But if you can deliver that return, well, then effectively you're still an investable company. The crux comes is carbon constraints get tighter and tighter. So there will become a tipping point where that ever increasing level of return perhaps gets out of reach unless you can then prove that you're actually reducing your risk as well.
I'm curious as to how do you then adjust for companies that are looking to reduce their exposure to carbon versus looking for offsets? How do you think about that balance?
Yeah, so it's a really good question, and that the markets, the market's the market, right? Everyone has differing assumptions, everyone has differing views. Some people think offsets are a good idea, other people don't. So the way, again, that I look at it is it's about providing information and disclosure and transparency for the market. So I view it that if we can get in the same, again, it's really useful that we've got credit ratings and debt exposure, because it's a really good analogy to think about carbon risk. In the same way that you have interest level, if you've got a debt position, you have an interest level exposure. Think of that as your carbon exposure. But what you can then do is, when you're looking, say you've got a corporate debt facility, you'll then look at it and go, okay, well, I will then enter into interest rate swaps or interest rate hedges. So from then I'll have my underlying position and then I'll have a hedge position. And that's sort of the way that I think we should look at it from a carbon offset perspective is you effectively have your underlying risk position, but then if you want to overlay carbon offsets in some way, shape or form, you can do that, and you get a new position, but it's a hedge position. So you can still then see what the underlying position is. And so then in the market, if you don't believe in carbon offsets or you don't believe in the particular type that's being used to hedge, you can actually understand where the underlying position is. Now, I will add one extra piece of this is our view, or my view around this is, if you're simply buying carbon offsets to be carbon neutral for this current year and all you're doing is buying spot offsets or carbon credits, you're not actually reducing your risk. You're doing some marketing. As a colleague or a friend said to me, that's a pledge, not a hedge. Whereas if you're entering into long-term contracts or long-term projects that are delivering a stream of carbon credits or some form of carbon product that is, exposure to, say, long-term compliance carbon allowances or credits that are always going to be sitting there. So if a carbon price does come in and carbon goes up by, goes up tenfold, you get that positive impact, that positive offset, then you are actually providing a hedge. But we need to be very clear between the carbon neutral, I'm carbon neutral and I'm retiring these cheap offsets versus I'm actually entering into a financial hedge.
As you think about the financial hedge for some parts of the market, it is going to be very difficult for them. I think about the real capital intensive parts of the production cycle, even things like real estate, infrastructure, which a lot of institutional investors have now got very large allocations because of the cash flows that come with them. There are a lot of emissions that come alongside these. How do you make sure that you then almost look at different industries in different ways to adjust for the existing level of carbon that they already have?
Yeah, so I think that is a big problem, and there is no one size fits all. And if one person or one organization tried to do, we've got the answer for every single sector, every single organization, and what technology is going to come out, I'm not really sure that's believable because we don't know what that answer is. But again, it's around providing the tools and the infrastructure and this, skill set for the market to be able to make these decisions themselves. So if we can come to a decision on what a globally consistent requirement would be, that is to say, if everybody had to do exactly the same amount of work given their carbon emissions and their carbon footprint from a value perspective, what we can then do, if we've all then got that, we can then basically make these decisions around sector experts or industry experts or company experts or company analysts who know the sector inside out. They can then start making these differing assumptions and say, okay, the baseline model says X, but we know that, say, for example, lithium and copper are going to be required to electrify the transport system. So those kind of mining, those kind of material activities, they could potentially get some form of subsidy or benefit from their emission, like protection from the emissions they generate, because they are going to be required. So if we say, well, okay, let's overlay that assumption into a globally consistent model and reconcile the differences, that's when you can start getting these, different sector analysis from the experts, but you can then always reconcile it back to the baseline level. So you can then go, okay, do we actually believe the assumptions that have been made? Or, well, I believe some of them, but I don't believe all of them. I guess it's in the same way as, Alex, if you and I wanted to buy and sell a company, you do a discounted cash flow model and I'd do a discounted cash flow model. Now, you being the buyer may think that it's worth $20 million. I'm the seller, I'll say it's 30 million, natural buy-sell tension. But we'll be able to reconcile the assumptions that we've made because we know we still have that consistent number. Now, I'll have a different WACC, you'll have a different growth rate, all that, but we'll be able to work out where the differences lie. Unfortunately for carbon, we don't have that baseline model yet. So if the market can get to a baseline model where everybody's globally consistent, we can then start changing and reconciling those differing assumptions within the industries, sectors, companies, whatever.
How much do you then need to rely on almost a global carbon price to help address that? Because it seems to me that there may be an arbitrage sort of issue here.
Yeah, so it's really interesting when we think about global carbon pricing is going to play an issue in some way, shape, or form. Like it is from an economic theory perspective, pricing carbon emissions is the most efficient way to decarbonize the global economy, because it literally searches for the lowest cost of abatement. However, if you're then trying to work out from a benchmark perspective or global carbon budget allocation, what is a global carbon price? You do sort of start to introduce a bit of uncertainty into the model, or there's a potentially single point of failure in what is your carbon price. So the way I sort of look at it is there's two ways to sort of do this. Is where you do use it, where there's ways to, I guess, benchmark requirements without global carbon pricing. Where you can look, we know what global carbon budgets look like. The science is pretty certain under, what a 1.5, 2, and 4 degree global carbon budgets look like. There are, there's variation within those scenarios, but you can get reads on carbon budgets for a 1.5, 2, and 4 degree world. We also know what some global proxies are, or global economic metrics. So, for example, we know what global GDP is today. Global GDP, it's around $86 trillion. And we know that in a global 1.5 degree world, if we were to decarbonize today, we'd only be allowed to generate around 24 billion tons of emissions. So from there, we can say, well, hang on a minute. We know that if we wanted to maintain our economic prosperity as a global society, but needed to live within the global carbon constraints, we need to generate around $3,400 for every single ton of CO2 that's generated. From there, we can actually start benchmarking and go, okay, are these revenue numbers for companies and all this, does it work in the 1.5? You can do the same thing for 2 and 4 degrees and all that. But you can't do that for every single metric. You don't do it for some. So then when you do have to use global carbon prices, that's when you have to use sensitivity analysis. And you have to say, okay, what does a global carbon price look like in a 1.5 degree world using these global carbon budgets, using the models? This is our best prediction, 2 degree and 4 degree. And then basically flex that scenario to say, how sensitive how resilient / sensitive is the company to these global carbon prices.
Are you then looking at carbon from a portfolio perspective as an institutional investor, or you're also looking at individual companies in terms of how they can reduce their exposure? Because carbon comes with a cost that they need to deal with. So I'm just curious around what angle you're looking at here.
So when we started all of this, we actually started at the company level. This was the corporates are the ones that are generating the emissions. Yes, the investors in effect finance them, but if you don't understand the source of the problem, or go down to the granular level of the corporates, it's a little bit hard. Yeah, you can maybe get a bit of an understanding, a top level view from a portfolio, but you really need to be able to drill down into the individual corporates. So we've always started with our first and foremost point is always the corporates. We always do the analysis on corporates first. But because it's always done in a globally consistent manner, data-driven, objective, scalable, and flexible and transparent, you can then actually build it up into a portfolio approach. So because if you've got a really solid base on understanding your global universe from a corporate perspective, it then allows portfolio approaches to be done, because a portfolio is simply just the weighted average of your corporate exposure. So that's how we've managed to look at it. It's been interesting as we've done it. There's a lot of people that talk around portfolios, and banks have a huge level of risk exposure to a decarbonising economy, because they finance, for example, if we take a bank's perspective, a bank is financing huge amounts of, coal-fired power stations, gas, aviation, whatever. And so from a footprint point of view, they look like that they've got huge exposure. But if we look at it from a carbon risk perspective, their carbon emissions may actually or their material carbon intensive companies that they finance, they may only make up 5 to 10% of their actual loan book or portfolio. So then when we look at it from their actual exposure, it's not as bad as we necessarily thought. Now, obviously, we want to optimize that. And if we're looking at temperature alignment, it's a different kettle of fish. But from a carbon risk exposure, you need to be understanding it. If you start at the granular level, from the corporates and build up, you can actually get a much stronger and robust portfolio understanding of carbon risk.
I'm curious then, because I think about portfolio construction and the ability to wash out the idiosyncratic risk as you build a portfolio. Would an investor then look at that and say, hold on, I've got this full portfolio of all different companies, different sectors, and I've actually sort of really reduced my exposure to carbon risk because I hold 200 companies?
Yeah, so you do effectively diversify away some of the carbon risk by holding more and more a diversified portfolio. It's exactly the same as when it's modern portfolio theory, effectively with a bit of a twist around carbon. You're diversifying away some of the risk. But if you wanted to optimize the portfolio, though, you can't. It's not as if the risk offsets itself, because that the one doing the analysis of knowing where the corporates are is like, you might say, okay, well, we've got this level of risk, but we can see that there's this 10% of our portfolio is still being an absolute drag on our portfolio. Okay, sure, we may not hit the wall the portfolio may not go underwater when like carbon becomes constrained, but we know that we've got this 10% of our holdings that are causing huge exposure. And as an investment analyst or an investment that's worth your salt, you're going to try and optimize that because all your competitors are doing it. And if you're not optimizing it and they are, all of a sudden your funds under management are going to flow to somebody that's actually outperforming you from a returns perspective. So when I said this, I know some people have said, well, hang a minute, but that's allowing people to hold high carbon stocks. And it's like, no, it's not allowing them. But what it's doing is it's pulling the blindfolds off and basically illuminating where the risk really sits so the market can actually do something about it. Because if we just jump up and down and say banks have huge risks and they've got massive exposure, well, that's simply not necessarily true. And if it's not the truth, we won't actually do anything about it. You've got to get to the underlying source of the problem to then do something about it.
I'm curious then as to who do you think will be the main consumer ultimately, or the end user of some of this data? Like if I think about a portfolio and the amount of carbon risk, is it the members that sit within a super fund and they look at the portfolio and its carbon risk and they can then make a decision of where to go? Is that potentially where it is? Or is it the ability for a fund to think about carbon risk and potentially the price that comes alongside that carbon exposure and them having to then change their portfolio? Which do you think is maybe the most important factor there?
So I think it's both. I think ultimately it's also shareholders and the corporates themselves, like the directors, the executive of big corporates as well, because this carbon risk will start spreading across across the whole economy, and you need to understand it. So I agree that members of superannuation, well, we've already seen it with the REST case, and there's other legal cases where members are going, you're not managing carbon risk, and my money is parked with you. I want to know that you're being, you've got the fiduciary responsibility. You're being a responsible investor to look after my risk, my money. So members are going to start wanting to understand this risk, but then because members are going to wanting to start understanding it, the super funds are then going to say, well, hey, man, we then need to understand what our fund managers are doing. The fund managers are going, well, hey, man, we need to understand where our risk sits. We want to understand what the corporates are doing. And this has all happened before governments have even actually done anything around carbon policy. You then overlay that with, hang on, a policy might come in that might then constrain carbon. Well, now we're overlaying it with a real financial risk. So then if you're worrying about underperformance of the market, you've then got every single investor going, well, hang on, we need to understand this. So shareholders now care about what their investments are doing within a company. Board members and directors of companies are going, well, hang on a minute, if I want to protect returns to shareholders and look after their interests, I need to start thinking about this. And then managers are like, well, hey, man, if my job, wait up, I work in a job that is very carbon intensive. I may not have a job tomorrow if I don't reduce emission intensity of what I'm doing. Well, hey, man, I need to care about this as well. You can sort of start to see where it's everybody in the whole system has to start caring about it. If we look at it from a financial risk, if we still sit it as it's ESG, only 5% of the market that wants to be green needs to care about it, we won't get that system change. But if you think of it like a financial risk or liability, everyone will start caring about carbon risk and how it's priced.
As a CFA myself, I've got to ask you this tricky question around risk. Ultimately, when we have greater risk, we expect higher returns, and we use that when we think about default risk in companies. Do we get to a point where increasing levels of carbon risk actually have a higher expected return?
Absolutely, 100%. that's quite an uncomfortable conversation to have with some people in this, not necessarily in the market, because people that are, that are definitely financially, like, spend their lives thinking about risk and return. They're like, okay, yeah, we get it. But I have Saturday night conversations a lot of the time. And when I boil it down, like, take the emotion out of climate and talk about risk and return, I get that question. So Hamid, you're saying that somebody can, like, generate more and more return, and that allows them to generate more and more carbon emissions. And it's like, yes, they can, but you've got to think of it, that only happens to a point, because the risks start to get so great because carbon budgets get tighter and tighter. And if you're an investor and you start seeing that and then not reducing it, yeah, it might be okay for 1 or 2 years, but there becomes a point where if the corporate isn't reducing emissions, they simply can't achieve the returns. Or if they are achieving the returns, the economic value to our society is so damn great that we have to let them, not have to let them, but the emissions that they are generating are so required for our economic prosperity that if they stopped, we're going to come to a grinding halt somewhere along the value chain. Now, that's sort of taking it to the nth degree, but that's where we're sort of looking at it, is it's effectively carbon budget allocation. And yeah, if you can generate enough return, it's basically saying the market is valuing you. For our economic systems to operate, we're allowing that to happen. The
corollary is within distress risk as well. You've got a monotonic relationship, more or less, until a point where you hit a tipping point, and then these businesses are totally destructive, and you'll burn and incinerate capital is one way to describe it.
Absolutely. Versus protecting capital, yes.
So in terms of this solution that you're looking at today, what is the types of applications that you've been working on at the moment for super funds?
So for super funds and also asset managers, there's two main sort of features that we've got at the moment. One is they can basically just understand individual company risk. So if you want to do engagement with the company, you want to understand where their risk lies, you can sit down and go, okay, we've got this lie. We know where your risks sit. Go and engage with the company. Responsible stewards of capital. They can basically work with the company and say, okay, we want you to do this because we can't necessarily divest you. And so in some forms, just simply divesting a company is not necessarily going to create change, because on the secondary market, you're just selling it to somebody else. So, whereas if you hold the capital and you can actually influence change within the company because you know where the risks lie, there's that point. So there's the engagement. It's basically intelligent engagement and much more efficient engagement. Then there's, I guess, portfolio understanding, construction of, well, okay, where do I think these companies are lying? Do I think that this company, it might have a high amount of carbon risk, but I can then do the work and the assumptions and what they're saying they're going to do. And actually, we think they can actually transition out of this the way they've put it, their plans and their strategic sort of objectives, they actually can work. And it does do enough to get them away, make them carbon productive enough. So you can start looking at portfolio allocations and say, well, actually, we're going to hold these companies because the market hates them, because they think that they're, negative screening or something's just blanketed them out. But we've done the work. We actually can see they've got a way out of this, a way to transition. And then thirdly, it's to basically pull it up into a whole portfolio analysis and really understand where your portfolio sits, so that you can either understand where your fund manager is doing, which ones are productive, which ones aren't doing as well. So you can, everybody's time poor, everyone is resource constrained. You can really just hone in on where the real risks are, but also you can report to members and you can say, well, we are covering our risks and these are what we're doing. And we're going, yes, we might be, slightly under, we might have carbon risk at the moment, but we're going to do X, Y, and Z. We're going to engage with company A, B, and C, and we'll improve their score, which then improves our score, and we'll manage the carbon risk exposure of your money in this manner.
You mentioned earlier around the need for quality data to get an understanding. How do you go about that? Obviously, in terms of making sure that it is transparent and it's also scalable and consistent across all the different companies in the sectors. That's a tricky thing, and every business has got different nuances. How do you go about just ensuring that there is consistency across the sectors and the market?
Yeah, so that's a really, really good question. And that's why we started in the public listed space. The way we look at everything does have applications for fixed income and private sector and private companies as well. It's just a matter of getting a hold of data, and that gets a little bit harder in those spaces. So we start with the public space simply because there's more data, but again, it's not perfect. So as we've said before, we integrate financial and carbon data. So the financial information is relatively easy to get, or when we say relatively easy, it's standardized to a certain degree. So we use FactSet as our source of truth for financial data, and they standardize it as well, which makes it, in data feeds and aggregate it, that's fine. Then what we do is we use, for our carbon data on scope 1, 2, and 3 emissions, we use ISS and ICON, ISS carbon data, and triangulate it and reconcile it against ICON, Refinitiv ICON data. But we don't stop there, because that sort of helps us give us a little bit of a base. But again, we realize that is very uncertain still. Scope 1, 2, and 3 is like they're either underreported, they're not reported, or they're uncertain. So we've got a very, very, and they're also lagged. So the data in the market right now is sort of 2019 carbon data. We're sitting in 2021. It's like there's a bit of a lag. Investors want timely information, so they also want timely carbon information if we're looking at risk. We use very, very sophisticated data science modeling, and also we have a very heavy data science team. To begin with, we do our own outlier analysis and correlation analysis. Like, I'm starting to speak beyond my remit here. I only just escaped through third year econometrics at uni, but it's probably a good thing. I probably won't bamboozle everyone with too many confusing terms, to help us get the next read on, okay, where if there's underreported information, what should it look like based from an industry perspective, sub-industry, sector, and all of this sort of level across, size of company, your scope 1 versus scope 2 versus scope 3, all these different cross correlations. But then we go one step further, is we're partnering and working with the University of Otago, who have actually developed the machine learning data model that's used, obviously, big data and AI and machine learning, to be able to predict carbon emissions based off energy data and financial information over using 10 years past data. What this all then allows us to do is not only can we get more timely information, we can actually predict corporate carbon emissions for 2021 as financial information comes to light. Every quarter financial information comes, we're actually generating predicted carbon emissions. But we know that doesn't have full-on accuracy. But because we've then got uncertainty bounds for scope 1, scope 2, and scope 3, we can propagate uncertainty bounds through the emissions numbers. We then propagate that through the carbon risk algorithms that we get. So we can then say we're 95% confident that you might have a medium to high carbon risk exposure, but we're 95% confident that you sit between medium to high and high, because of where we know that the outer bounds are. So yes, there's uncertainty in this data, but if we treat it like a data problem and use scientific, data science to our benefit, we can actually get to an order of magnitude to say, okay, I can't tell you whether someone's got $30 million or $50 million at risk. What I can tell you, the way they're operating their business is they have a high level of risk, or a medium to high. It's the same way credit ratings don't tell you how much money is at risk. It's AAA, AA. There's risk tolerances, and that's the way we look at it as well. And then we go one step further. Once we get corporates engaging, is obviously they can then come in and validate their system or their scores. When you have institutional investors going, okay, well, we've got a rough idea, but if you come in and work with the system, they can then make that system much more accurate, which gives investors confidence that the corporates are engaging with everything that's going on, and then also giving a much more accurate level, and then doing the work from there.
All right, Michael, that's been a fantastic conversation. A lot of insights there for both asset managers and as asset owners, as you said. Thank you very much for your time today.
No worries. Thanks for having me, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.